Listen closely, because the banks are betting against you. Right now, every time you make a minimum payment, you are throwing your hard-earned wealth into a black hole called compound interest. But there is a back door. There is a way to freeze that interest, stop the bleeding, and use the bank's own capital to buy your freedom. It's called the 0% APR balance transfer, and it is the most powerful weapon in the debt fighter's arsenal if you know how to wield it. In this audio experience, I will teach you the mathematical blueprint to legally stop paying interest for up to 18 months. The clock starts now. Chapter 1. Stop feeding the interest monster. Every morning, you wake up poorer than you were when you went to sleep. This isn't a metaphor. It isn't a figure of speech. It is a mathematical reality for millions of Americans. While you sleep, while you work, while you spend time with your family, there is a machine running in the background of your life. It is silent, it is relentless, and it has one singular purpose: to transfer wealth from your pocket into the vaults of a bank that is already too big to fail. That machine is called compound interest. Albert Einstein famously called compound interest the eighth wonder of the world, stating that he who understands it earns it, he who doesn't pays it. Right now, if you are carrying credit card debt, you are on the wrong side of that quote. You are paying for the bank's skyscrapers. You are funding their executive bonuses. You are the fuel for their engine. The first step to financial freedom is not making more money. It is stopping the bleeding. You must understand the enemy before you can defeat it. In this chapter, we are going to look the monster in the eye. We are going to do the math that the credit card companies pray you never do. And we are going to change the way you view your debt forever. The math of destruction. Let's talk numbers. Let's talk about what is actually happening when you swipe that card. The average credit card interest rate in the United States hovers around 20% to 25%. For those with lower credit scores, it can skyrocket past 30%. Most people look at their statement, see a minimum payment of $85 on a $3,000 balance, and think, I can handle that. This is the trap. This is how they get you. When you pay only the minimum, you are mostly paying interest. You are treading water. Let's say you have $10,000 in credit card debt at a 24% APR. That 24% means you are being charged roughly $2,400 a year just for the privilege of owing that money. Break that down. That is $200 a month. That is roughly $6.50 every day. Imagine walking into a coffee shop every morning, taking a $5 bill and 2 singles out of your wallet and setting them on fire. You get no coffee, you get no service. You just burn the money and walk away. You would never do that. You would call someone crazy for doing that. Yet, that is exactly what you do every day you carry a high-interest balance. The bank loves a minimum payment borrower. To them, you are the perfect customer. You are an endless stream of profit. If you pay the minimum on that $10,000 debt, it could take you over 25 years to pay it off. By the end, you won't have paid $10,000. You will have paid over $30,000. You paid for the item 3 times over, once for yourself and twice for the bank. It's not about income, it's about discipline. You might be thinking, I just need a raise. If I made more money, this wouldn't be a problem. That is a lie. High-income earners go broke every day because they don't understand the math of destruction. You cannot out-earn a 25% interest rate. The market doesn't return 25% consistently. Real estate doesn't return 25% consistently. Your debt is growing faster than your wealth ever could. The psychological shift. To defeat the interest monster, you must fundamentally rewire your brain. Most people view debt as a normal part of the American experience. We are taught that it's normal to have a car payment, a mortgage, and a credit card balance. We are desensitized to the red numbers on the screen. This complacency is fatal to your financial future. You must stop viewing interest as a fee. You must start viewing it as an emergency. If a pipe burst in your kitchen and water was flooding your hardwood floors, would you say, "I'll fix it next month"? Would you pay the minimum on the repair? No. You would panic. You would shut off the water immediately. You would do whatever it took to stop the damage because your home, your asset, was being destroyed. High-interest debt is a burst pipe in your financial house. Every day it flows, it rots your future. It destroys your investment. It steals your retirement. That's the key. You have to get angry. You have to look at that interest charge on your statement and feel a visceral reaction. You need to declare war on the APR. You don't need their permission. The banks rely on your passivity. They rely on you feeling helpless. They want you to think that the 24% rate is set in stone, that you have no options, and that you are lucky they lent you money at all. But you don't need their permission to stop playing their game. You don't need their permission to find a better deal. You are the customer, and you have the right to fire them. The example, the tale of two borrowers. Let's look at two people to illustrate the cost of inaction. Let's call them Mark and Sarah. Both Mark and Sarah live in the same city. They both earn $60,000 a year. And due to some bad luck and car repairs, they both find themselves with exactly $5,000 in credit card debt on a card charging 22% interest. Mark decides to play it safe. He keeps the debt on his current card. He tightens his belt and commits to paying $200 a month toward the debt. He feels responsible. He feels like he is doing the right thing. Sarah, however, understands the game. She refuses to pay 22% interest. She applies for a balance transfer card with a 0 APR for 18 months. She pays a 3% fee, $150, to move the debt. She also commits to paying $200 a month. Let's fast forward 18 months. Mark has been paying $200 faithfully every month. He has sent the bank $3,600 of his hard-earned money. But because of the 22% interest, his balance is still hovering around $1,900. He has paid thousands, but he is barely halfway done. Of that $3,600 he paid, nearly $1,400 went straight into the furnace of interest. He received zero value for that $1,400. Now let's look at Sarah. Sarah paid the $150 fee at the start. She also paid $200 a month. But because her interest rate was zero, every single penny of that $200 attacked the principal balance. After 18 months, she has paid $3,600. Her remaining balance is only $1,550. But here is the real difference. Sarah has saved over $1,000 in interest charges. That is $1,000 she can now invest. That is $1,000 she can use for an emergency fund. Mark worked just as hard as Sarah. Mark was just as disciplined as Sarah. But Mark is poorer because he ignored the math. You have a choice. You can be Mark, grinding away at a mountain that keeps growing, or you can be Sarah, using the system to flatten the mountain. The difference wasn't money, it was strategy. This audiobook is not about teaching you how to endure debt. It is about teaching you how to dominate it. The strategy Sarah used is the exact strategy we are going to break down in this book. We are going to take that 22%, 25%, or 30% interest rate and drive it into the ground. We are going to turn it to zero. But before we can wield the weapon, we have to understand how it works. You have to understand that the banks aren't offering you 0% rates out of the kindness of their hearts. They are setting a trap. They are betting that you will make a mistake. They are betting that you are lazy. But you aren't going to be lazy. You are going to be precise. In the next chapter, we are going to pull back the curtain on the balance transfer industry. I'm going to show you exactly why banks offer free money, the hidden mechanics of the transfer, and the fatal errors that trap most people before they even begin. You have identified the monster. Now, let's pick up the weapon. Chapter 2. Understand the 0% APR weapon. If you walk down the street and a stranger offers you a free loan for $10,000 with 0 interest for 18 months, you would call the police. You would assume it's a scam. You would assume there are strings attached that will eventually choke you. Yet, when a multi-billion-dollar bank sends you a glossy envelope offering the exact same thing, millions of Americans accept it without asking the most important question: why? Why would a bank, an institution designed solely to generate profit, give you access to their capital for free? Why would they voluntarily pause the interest clock? Are they charitable? Are they trying to help you get back on your feet? Absolutely not. To master this strategy, you must stop thinking like a consumer and start thinking like a lender. You need to understand the trap before you can steal the bait. This chapter is about the mechanics of the balance transfer, but more importantly, it is about the casino model of modern banking. Why banks offer free money? The banking industry operates on statistics, not feelings. They have teams of actuaries and data scientists who have calculated the probability of your failure down to a decimal point. When a bank offers you a 0% APR balance transfer for 15 or 18 months, they are making a calculated bet. They are betting that you are undisciplined. They are betting that you will transfer the debt, feel a sudden wave of relief, and then fail to pay it off before the clock runs out. Here is the cold, hard truth. The banks know that a massive percentage of people who execute a balance transfer do not pay off the principal within the promotional period. When you transfer your balance, the bank usually charges a fee, typically 3% to 5% of the total amount. That is their entry fee. They make that money immediately. But the real prize is what happens in month 19. If you still owe money when the promotion ends, the interest rate doesn't just go back to normal, it often shoots up to the highest allowable penalty rate. They are banking on life getting in the way. They know your car will break down. They know you will want to go on vacation. They know you will lose focus. They are handing you a rope, hoping you will hang yourself with it. You have a choice. You can be the statistic they profit from, or you can be the outlier that exploits their system. The mechanics, how it actually works. Let's strip away the marketing fluff and look at the nuts and bolts of a balance transfer. A balance transfer is simply the act of using one credit card to pay off another. It is debt relocation. It is not debt settlement. It is not debt forgiveness. You are moving your burden from your left shoulder to your right shoulder. Here is the process. You apply for a new card, let's call it the Freedom Card, that offers 0% APR on transfers for 18 months. Once approved, you tell the Freedom Card issuer that you want to pay off your old debt on your high-interest card. The Freedom Card bank sends an electronic payment, or sometimes a physical check, to the high-interest card bank. Your old balance goes to zero, your new balance appears on the Freedom Card. For the next 18 months, every time you make a payment to the Freedom Card, 100% of that money goes toward reducing the debt. There is no interest charge eating up your cash. This is the golden window. However, there are rules. That's the key. If you violate the rules, the weapon backfires. Rule number 1, the cross-bank barrier. You generally cannot transfer a balance between cards issued by the same bank. You cannot transfer debt from a Chase Slate card to a Chase Sapphire card. The bank already owns that debt. They have no incentive to cut their own interest profits. You must move the debt to a competitor. You are essentially refinancing your debt with a rival bank. Rule number 2, the transfer cap. Just because you are approved for the card does not mean you can transfer your whole debt. If you owe $10,000, but the bank only gives you a credit limit of $5,000, you can only transfer $5,000 minus the transfer fee. You must be prepared for this limitation. Rule number 3, the fee equation. As mentioned, there is usually a fee. If you transfer $10,000 with a 3% fee, your new balance will be $10,300. Many people hesitate here. They hate the idea of adding $300 to their debt instantly. This is short-term thinking. You must do the math. If you kept that $10,000 at 24% interest, you would pay $2,400 in interest over the next year. Paying $300 once to save $2,400 is the best investment return you will ever find. The warning: buying time, not freedom. This is where the tough love comes in. The 0% APR hack is a double-edged sword. When you execute the transfer, the pressure disappears. The phone stops ringing. The scary interest charges vanish from your statement. This silence is dangerous. The greatest risk of a balance transfer is that it treats the symptom, interest, without curing the disease, spending habits. I have seen countless people transfer their debt, celebrate their genius, and then proceed to rack up new debt on the old card that now has a zero balance. 6 months later, they don't just have the transfer debt, they have new high-interest debt on top of it. They have doubled their problem. It's not about income, it's about discipline. If you transfer a balance and do not have a ruthless, automated plan to pay it off, you are committing financial suicide. You are simply kicking the can down the road, and when you finally catch up to that can, it will be heavier and harder to kick. You must understand that the clock is ticking from the moment the transfer clears. 18 months sounds like a long time. It is not. It will fly by. If you don't attack the principal immediately, you will wake up in month 17 in a panic. The purchase trap. There is one final technical trap you must avoid. Do not, I repeat, do not use your balance transfer card for new purchases. If you buy a $5 coffee on your balance transfer card, you have complicated your account. Payments are often applied to the lowest interest balance first, or sometimes the highest, depending on the terms. But mixing 0% debt with new purchase debt creates a mess that the banks love to exploit. Keep the card clean. Put it in a drawer. Do not put it in your digital wallet. Do not use it for Netflix. It is a debt prison, not a spending tool. You don't need their permission. The banks have set the table. They have laid out the trap. They have invited you to dinner, expecting you to be the main course. But you don't need their permission to flip the script. You can walk in, take the 0% rate, ignore the temptation to spend, pay off the principal, and walk out without giving them a dime of profit. That is the game we are playing. But before you can apply for this card, before you can make the transfer, you have to know where you stand. You cannot apply blindly. A rejected application hurts your credit score and wastes precious time. In the next chapter, we are going to perform a forensic audit of your financial life. We are going to look at your credit score, your utilization ratio, and the unspoken requirements for approval. You need to know if you are qualified to enter the arena before you step through the gates. Chapter 3. Audit your financial health before you apply. You are ready to fight. You understand the math. You understand the trap. You are eager to apply for that 0% card and stop the bleeding. But you need to stop right now. Applying for credit is not like buying a pair of shoes. You don't just walk in and take what you want. Every time you submit a credit application, you are being judged. The banks are looking at your financial resume, and if they don't like what they see, they will reject you. A rejection is not just a no, it is a penalty. A hard inquiry hits your credit report, lowering your score. If you apply for 3 cards in a panic and get rejected by all of them, you have just made your situation significantly worse. You have damaged your reputation with the very institutions you need to help you. Before you fill out a single form, you must perform a forensic audit of your own financial life. You need to see yourself exactly as the algorithm sees you. This is about preparation. This is about entering the battlefield with your eyes open. The credit score floor. First, let's talk about the magic number, your FICO score. The best balance transfer cards, the ones with 18 or 21 months of 0% interest and low fees, are reserved for prime borrowers. Generally, this means you need a credit score of 670 or higher. If you are in the 700s, you are in the safe zone. If you are in the 800s, you can practically pick any card you want. If your score is below 670, your odds of approval drastically. You might still get approved, but the limit will be low, or the 0% term will be short, maybe only 6 or 9 months. You have a choice. You can apply blindly and hope for the best, or you can check your score right now. Use your current banking app. Use Credit Karma. Use Experian. Know your number. If you are sitting at a 660, it might be worth waiting 30 days to pay down a small balance or fix an error to bump yourself into the 670s before you apply. Strategy beats speed. The utilization ratio, the hidden killer. Your credit score is important, but there is a metric that matters even more for balance transfers: credit utilization. This is the percentage of your available credit that you are currently using. If you have a $10,000 limit and you owe $9,000, your utilization is 90%. To a bank, 90% utilization screams risk. It says you are maxed out. It says you are desperate. If you apply for a new card while your current cards are maxed out, the new bank will likely reject you, even if your payment history is perfect. They think, if I give this person more credit, they are just going to max this out too. That's the key. The banks want to lend to people who don't need the money. It's a paradox. If your utilization is high, you might need to use a sniper approach. Do you have a small savings account? Can you sell something? If you can pay down your current balance to bring utilization under 70 or 50% before you apply, your approval odds skyrocket. There is also a psychological trick here. Banks report your balance to the credit bureaus once a month, usually on your statement closing date. If you make a big payment the day after the statement closes, the bank won't report that lower balance for another 30 days. The algorithm won't know you paid it down. You must pay down the balance a few days before the statement closes. Ensure the lower balance is what gets reported. Then wait for your credit score to update. Then apply. You are manipulating the data to present the best version of yourself. The reality check. List the enemy. Now you need to get physical. I want you to take a piece of paper and a pen. Do not do this in your head. Do not do this on your phone. You are going to list every single debt you have. You need to create a war room map of your finances. Create 4 columns. Creditor name. Example, Chase, Capital One, Discover. Current balance, the exact amount you owe. Interest rate, the APR you are currently paying. Monthly payment, the minimum you are required to pay. Most people are terrified to do this. They are afraid to see the total. They live in a state of willful ignorance. It's not about income, it's about discipline. You cannot fight an enemy you cannot see. When you write it down, you take away its power. You turn a scary, vague feeling of being broke into a cold, hard math problem. Look at the interest rate column. Circle the highest number. That is your priority target. That is the fire you need to put out first. Look at the balance column. Add it up. That total number is the amount of credit limit you need to secure. If you owe $15,000 total, getting a transfer card with a $2,000 limit won't solve your problem. You need to know the scale of the solution required. The inquiries rule. Check your credit report for hard inquiries in the last 12 months. A hard inquiry happens every time you apply for credit. If you have applied for 5 credit cards in the last 6 months, stop. Do not apply for a balance transfer card yet. You look thirsty to the banks. Recent aggressive credit seeking is a red flag. You need to let your report cool off for 3 to 6 months. You don't need their permission. You don't need a banker to tell you if you are financially healthy. You have the tools to audit yourself. By checking your score, optimizing your utilization, and listing your debts, you are doing the due diligence that 99% of people ignore. You are moving from a desperate borrower to a strategic operator. Once you have your credit score, your utilization strategy, and your total debt number, you are finally ready to go hunting. But you aren't just going to Google best credit card. That is how amateurs get trapped with high fees and short terms. In the next chapter, we are going to learn how to hunt. I will teach you the fee versus term trade-off, how to spot the introductory traps, and the one crucial rule about bank rivalries that you must follow if you want this transfer to work. Get your audit done. The hunt begins now. Chapter 4. Hunt for the perfect offer. You have done the math. You have audited your financial life. You know your credit score, and you have a list of your enemies, the debts that are draining your bank account every single month. Now it is time to go hunting. But be warned, the financial jungle is dense, and it is filled with traps. The banks spend billions of dollars on marketing designed to dazzle you. They use bright colors, smiling faces, and bold fonts shouting 0% APR to get you to click. But what they put in the headlines is often very different from what they hide in the fine print. If you click on the first offer you see, you might find yourself approved for a card that charges a massive annual fee, offers a short promotional period, or worse, a card that rejects your transfer entirely because you didn't know the rules of the game. You are not browsing for a credit card. You are selecting a financial weapon, and you need to pick the one that fits your specific battle. The bank rivalry rule. Before you even look at interest rates or fees, there is one golden rule you must memorize. If you ignore this, you will fail instantly. You cannot transfer a balance within the same bank. This is the most common mistake beginners make. Let's say your $5,000 debt is on a Chase Freedom card. You see an offer for a Chase Slate card that offers 0% APR on balance transfers. You think, great, I already bank with Chase. This will be easy. Wrong. Chase will not let you transfer debt from one Chase card to another Chase card. Why would they? Right now, they are earning 24% interest on your debt. Why would they voluntarily move that debt to a new account where they earn 0%? They are in the business of making money, not doing you favors. You must target a competitor. If you are in debt to Chase, you must apply for a card from Citi, Capital One, Discover, or Bank of America. You are essentially refinancing your debt with a rival. You are taking your business and your debt across the street. That's the key. Look at the list of creditors you made in the previous chapter. Next to each one, write down must transfer to competitor name. You have to play the game by their rules to win. The fee versus term trade-off. Once you have identified the right banks, you need to analyze the offer. There are two variables that matter: the balance transfer fee and the promotional term. Almost every balance transfer card charges a fee to move the money. The industry standard is 3%. If you transfer $10,000, they charge you $300. Some cards, however, charge 5%. On $10,000, that is $500. You might think, obviously, I should take the 3% fee. Not necessarily. The 5% cards often come with longer promotional periods, sometimes up to 21 months. The 3% cards might only offer 15 months. You have to do the math on your monthly cash flow. You have a choice. Option A. You pay a $300 fee on a $10,000 debt, and you get 15 months to pay it off. That means your monthly payment is approximately $686. Option B. You pay a $500 fee on the same $10,000 debt, but your repayment terms are different. Depending on the plan, you may get more time, lower monthly payments, or a different interest structure compared to option A, and have 21 months to pay it off. That requires a monthly payment of roughly $500. If your budget is tight and you can only afford $500 a month, option A is a death trap. You won't finish paying it off in 15 months, the interest will kick back in, and you will lose. In that case, paying the higher fee, option B, is worth it because it buys you the time you need to succeed. Don't be penny wise and pound foolish. Calculate your mandatory monthly payment for each scenario. Pick the card that fits your budget, not just the one with the lowest upfront fee. Reading the fine print, the introductory trap. Now we need to put on our reading glasses. The banks love to hide crucial details in the terms and conditions. First, look for the transfer window. Most cards require you to execute the balance transfer within the first 45 to 60 days of opening the account to get the 0% rate. If you open the card, wait 3 months, and then try to transfer the balance, you might be charged the standard interest rate. You must act fast. Second, check for annual fees. Some premium cards offer balance transfers but charge a $95 annual fee. Avoid these. There are plenty of cards with 0 annual fees. Why pay $95 to save money? It defeats the purpose. You want a no annual fee card. Third, look for the phrase deferred interest. We will cover this in depth later, but for now, know this. You want a card that offers a true 0% APR introductory period, not a deferred interest store card. The language matters. The pre-approval tool. How do you hunt without getting hurt? You use pre-approval tools. Most major banks have a page on their website where you can check for pre-qualified offers. This performs a soft pull on your credit, which does not hurt your score. It will tell you if you are likely to be approved before you submit the official application. Do not submit a formal application until you are reasonably sure you will get a yes. Remember the lesson from Chapter 3. Multiple hard inquiries make you look desperate. It's not about income, it's about discipline.
The discipline here is patience. It is the discipline to read the small print when you just want to click submit. It is the discipline to calculate the fee versus the term. Most people skip this step. They see 0%, they click apply, and then they realize they only got a $1,000 limit, or they applied to the same bank they already owe money to, or they got hit with a 5% fee when they could have gotten 3%. You are not most people. You are a strategist. You don't need their permission. You don't need the bank to tell you which deal is best. They will always highlight the features that make them money. They will highlight the cash back or the points distractions designed to make you forget about the transfer fee. Ignore the rewards. Ignore the points. You are not here to earn airline miles. You are here to destroy debt. Your mission is simple. Find a card from a competing bank. Ensure you qualify. Score 670 plus. Calculate the monthly payment based on the term length. Verify there is no annual fee. Check for pre-approval. Once you have identified the target, the perfect card that balances fee, term, and eligibility, it is time to pull the trigger. But the application process itself has its own hurdles. How much income do you declare? What happens if they don't give you the full credit limit you need? How do you actually move the money? In the next chapter, we move from planning to execution. I will walk you through the application process step by step, explain how to handle a partial approval, and give you the specific protocol to verify that the transfer actually worked. You have the target in your sights. In Chapter 5, we take the shot.
Chapter 5. Execute the transfer with precision. You have your target. You have selected the card, done the math, and checked your eligibility. The planning phase is over. Now it is time for execution. This is the moment of truth. But even with the perfect plan, things can go wrong during the application process. A typo in your income, a misunderstanding of the credit limit, or a failure to verify the transaction can turn a strategic victory into a bureaucratic nightmare. We are going to walk through this process step by step. This is not just about filling out a form. It is about managing the transfer to ensure every penny lands exactly where it is supposed to. The application process. When you sit down to apply, you need focus. Close the other tabs on your browser. Put your phone away. You are signing a legal contract for thousands of dollars. Treat it with respect. The application will ask for standard information: name, address, social security number. Then it will ask for your employment and income. This is where people get nervous. They ask, should I include my spouse's income? Should I include my side hustle? You have a choice. You can be conservative and only list your W-2 salary, or you can be accurate and list your total household income. The Card Act of 2009 allows you to include any income to which you have reasonable expectation of access. If you are married and your spouse's income helps pay the bills, you can often include it. If you have a side gig, include it. Why does this matter? Because your income is the primary factor alongside your credit score that determines your credit limit. And as we discussed, the credit limit is everything. You want the highest limit possible to absorb your debt. List every dollar you can legally claim. The transfer request. During the application, most banks will ask, do you want to transfer a balance now? Some experts say, wait until you get the card. I say, do it now. Why? Because it locks in your intent. It tells the algorithm exactly why you are here. You will need the account number of your old high-interest card and the amount you want to transfer. That's the key. Do not try to transfer the exact total of your debt down to the penny if it is close to your expected limit.
Leave a buffer. The transfer limit, the hidden cap. This is the hurdle that trips up the most prepared borrowers. Let's say you are approved for a $10,000 credit limit. You cheer. You have $10,000 in debt. Perfect fit, right? Wrong. The bank will not let you max out the card on day one. They also have to account for the balance transfer fee. If the fee is 3% and you transfer $10,000, the total balance becomes $10,300. That is over your $10,000 limit. The transfer will be rejected, or more likely, the bank will only transfer a portion of the debt, leaving you with a balance on the old high-interest card. Furthermore, many banks have a policy that you can only transfer up to 75% or 90% of your total credit limit. If you get a $10,000 limit, they might only let you transfer $7,500. You must be prepared for a partial transfer. If this happens, do not panic. Transfer what you can. Moving $7,500 at 0% is still a massive victory, even if $2,500 is left behind. You attack the left behind balance first with your cash flow, while the transferred balance sits on ice. The verification. Trust but verify. You hit submit. The screen says, "Congratulations, you are approved." You feel a wave of relief. You think you are done. You are not done. The digital banking system is efficient, but it is not flawless. Transfers can get stuck. Account numbers can be mistyped. For the next 7 to 10 days, you must be a hawk. Log in to your new account. Check the status of the transfer. Is it pending? Is it processing? Log in to your old account. This is the most important part. Until you see a zero balance on that old high-interest card, you are still paying interest on it. Do not skip a payment on the old card just because you initiated a transfer. If your payment due date hits while the transfer is in limbo, pay the minimum. If you miss that payment, you will get hit with a late fee and your credit score will drop, all while you were trying to fix your finances. Once the transfer clears, you will see a credit on the old account or a zero balance and a debit on the new account. Only then can you exhale. It's not about income, it's about discipline. The discipline to follow through is what separates the wealthy from the indebted. The wealthy check the details. The wealthy verify the transaction. The broke assume it's probably fine. You don't need their permission. If the transfer takes longer than 10 days, pick up the phone. Call the new bank. Ask for the status. You don't need their permission to be annoying. You are the customer. It is your money. If there is a delay, demand an answer. The setup for success. Once the transfer is verified and the dust settles, you are standing in a new landscape. Your high-interest debt is gone, replaced by a 0% balance on a new card. You have successfully bought yourself time. But remember, the clock started ticking the second you were approved. You now have a 15, 18, or 21-month runway. The math has changed. Your monthly payment has changed. In the next chapter, we are going to build the payoff timeline. We are going to calculate the exact dollar amount you need to pay every month to ensure you hit the finish line before the interest rate explodes. We aren't guessing anymore. We are building a machine to destroy this debt once and for all. The transfer is done. Now the real work begins.
Chapter 6. Build the mathematical payoff timeline. The transfer is complete. You have successfully moved your debt from a burning building to a freezer. The fire is out. The 20% interest rate is gone. You are now staring at a balance of, let's say, $10,000 with a 0% APR for the next 18 months. Most people stop here.
They look at their minimum payment, which might be $25 or $35 on that $10,000 balance, and they breathe a sigh of relief. They think, I can relax now. I'll pay a little bit here and there. This is the exact moment you lose the war. If you pay the minimum on a 0% balance transfer card, you will reach the end of the 18 months with almost the entire debt still remaining. Then the interest rate will spike to 25%, and you will be right back where you started, only 18 months older and having wasted a golden opportunity. You did not go through the trouble of auditing your credit, hunting for an offer, and paying a transfer fee just to relax. You did it to attack. Now we build the timeline. We are going to use cold, hard division to dictate your life for the next year and a half. The division method. This is the simplest, most powerful math you will ever do. Take your total transferred balance, including the fee. Take the number of months in your 0% promotional period. Subtract 1 month from that period. Why subtract a month? Because you need a safety buffer. If the promotion is 18 months, you plan for 17. If it's 21, you plan for 20. You never want to be racing the clock on the very last day. The formula: total debt divided by promo months minus 1 equals mandatory monthly payment. Let's run the numbers. Total debt, $10,300. Original $10,000 plus 3% fee. Promo period, 18 months. Safety period, 17 months. You take a $10,300 balance, and when you divide it by 17 months, you get $605.88. So your new monthly payment is $606. Not $25, not $100, but $606 every month. This number is not a suggestion. It's the required payment. It is a bill. You must treat this calculated payment exactly like your rent or your mortgage. It is non-negotiable. That's the key. The bank will tell you the minimum payment is $30. You must ignore the bank. The bank is lying to you. The bank wants you to fail. Your real minimum payment is the number that gets you to 0 before the interest strikes. Automating success. Willpower is a finite resource. You might feel motivated today, but in 6 months, when you want to buy a new phone or go on a trip, you will be tempted to skip a payment or pay less. You cannot rely on your future self. You must force the decision now. Log into your new credit card account immediately. Go to the Auto Pay section. Do not select minimum payment. Select fixed amount or custom amount. Enter your calculated number, $606. Set it to draft from your checking account every single month on payday. It's not about income, it's about discipline. Discipline isn't about making the right choice every day. Discipline is setting up a system so you don't have to make a choice. By automating the payment, you remove the emotion. You remove the temptation. The money leaves your account before you even see it. You learn to live on what is left. The principal. Here is the beautiful part. This is the payoff. For years, when you sent money to the credit card company, half of it evaporated into interest. You threw $200 at the debt and the balance only went down by $80. It was demoralizing. It felt like shoveling sand against the tide. Now, because of the 0% rate, every single penny fights for you. When you send that $606 payment, your balance drops by exactly $606. Month 1, $10,300 into $9,694. Month 2, $9,694 into $9,088. Month 3, $9,088 into $8,482. Watch the numbers fall. It is addicting. For the first time, you are seeing a direct correlation between your effort and your results. This momentum is powerful. It changes your psychology. You stop feeling like a victim and start feeling like a conqueror. Adjusting the timeline. What if you do the math and the number is too high? What if 10,300 divided by 17 is $606, but you honestly only have $400 a month in your budget? You have a choice. Option A, you lie to yourself, promise to pay $606, fail, and get discouraged. Option B, you accept reality. You set the autopay to $400, the max you can afford. If you pay $400 a month for 17 months, you will pay off $6,800. You will still have $3,500 remaining when the promo ends. Is this a failure? No. You have eliminated $6,800 interest-free. That is a massive win. But you must be aware of the Plan B scenario for that remaining $3,500. You know today that you won't finish in time, so you can plan for another transfer or a lump sum payment down the road. Clarity is better than delusion. You don't need their permission. You don't need the bank to set your payment terms. You set them. By using the division method, you are taking control of the timeline. You are deciding when you become free. But there is a threat to this timeline. It's not the interest rate. It's not the bank. It's you. The moment you see that zero balance on your old credit card, your brain is going to play a trick on you. It's going to whisper, "Look, you have no debt on that card. You have available credit. You can spend again." This is the zero balance illusion. And if you fall for it, you will destroy everything you have just built. In the next chapter, we are going to deal with the old card. We are going to talk about the psychology of restraint, and I am going to give you the physical steps you must take to ensure that zombie debt doesn't rise from the grave. The math is set. Now we secure the perimeter.
Chapter 7. Freeze the plastic, the psychology of restraint. You have set up the math. You have automated the payments. The system is running. But now you are facing a dangerous psychological trap. It is a trap so subtle that most people walk right into it with a smile on their face. You log into your old credit card account, the one that used to keep you up at night, with a $10,000 balance. You look at your statement, and you see a beautiful round number, $0.00. Your available credit is back to $10,000. It looks like free money. It looks like relief. It looks like you solved the problem. You didn't solve the problem. You moved it. The debt is still sitting on your shoulders. It's just wearing a different shirt. But your subconscious brain doesn't understand that. It sees available credit and thinks spendable cash. This is the zero balance illusion. If you do not physically and mentally lock down that old card, you will end up in a situation worse than where you started. You will have the maxed out balance transfer card plus a new balance on the old card. This is how people go from $10,000 in debt to $20,000 in debt in less than a year. The zero balance illusion. Why do we do this? It's called lifestyle creep, mixed with scarcity fatigue. You have been stressed about money for so long that seeing that open credit line feels like oxygen. You think, I'll just put one tank of gas on it. Then I'll just buy groceries this week. Then I deserve a nice dinner. Before you know it, you are carrying a $2,000 balance at 24% interest again, while also trying to pay off the $10,000 transfer. That's the key.
You must understand that you are an addict. If you are in consumer debt, you are addicted to spending money you do not have. You cannot treat a loaded gun like a toy. You must remove the temptation entirely. The physical barrier. You need to create friction. You need to make it physically difficult to use that old card. You have a choice. You can leave it in your wallet for emergencies, or you can be honest with yourself and lock it away. Here is the protocol. Remove it from your wallet. Do not carry it. If it is in your pocket, you will use it. Delete it from your digital life. Go to Amazon, Apple Pay, Google Pay, Uber Eats, and any other app where the card is saved. Delete the card. If you have to walk across the room, find the card, and type in the 16 digits to buy something, you are far less likely to make an impulse purchase. The ice block method. This is old school, but it works. Put the card in a plastic cup of water and freeze it. If you have a true emergency, you have to wait for the ice to melt. That gives you time to think. Is this really an emergency, or do I just want pizza? Do not close the account. This is a common question. Should I just close the old card? No. Closing the account will hurt your credit score in two ways. It reduces your total available credit, which spikes your utilization ratio. It reduces the average age of your credit history if it's an older card. Keep the account open. Keep the history. Just stop using the plastic. The new card rule. Now let's talk about the new card, the one with the balance transfer on it. Never, under any circumstances, make a new purchase on your balance transfer card. I cannot stress this enough. This card is a debt prison. It is not for spending. If you buy a $20 lunch on your balance transfer card, you have just complicated the math. Some banks apply your payments to the lowest interest balance first, the transfer, leaving your new purchase, the lunch, to accrue interest at a high rate. Other banks have trailing interest rules. It is messy. It voids the purity of the 0% strategy. Take the new card. Put a sticker on it that says "Debt Only." Put it in a drawer. Do not activate the physical card if you don't have to. Do not memorize the number. Do not save it in your browser. It's not about income, it's about discipline. Discipline is knowing your weaknesses. If you know you love to shop online, block the sites. If you know you spend too much at the bar, leave the cards at home and bring cash. You are in a rehabilitation phase. You are detoxing from debt. You cannot detox if you keep the drug in your pocket. You don't need their permission. The banks want you to carry the card. They want you to feel rich. They send you emails saying, "You have $10,000 available. Upgrade your life." Delete the email. You don't need their permission to ignore them. You are playing a long game. The emergency fund paradox. But what if I have a real emergency? If your car breaks down and you have zero cash, you might be forced to use a credit card. This is why the balance transfer strategy must be paired with a small emergency fund. Even while you are aggressively paying down debt, try to keep $1,000 in a checking account. This is your shield. This prevents you from having to reach for the plastic when a tire blows out. If you have to use a credit card for an emergency, use the old one, the one with the zero balance. Pay it off immediately if possible, and leave the balance transfer card alone. Keep the contamination contained. The psychology of the finish line. By locking away the old card and refusing to use the new one, you are changing your identity. You are no longer a consumer. You are a payer. You are shifting from a mindset of, "Can I afford the monthly payment?" to, "Can I afford the total cost?" This restraint is painful at first. It feels restrictive. But as you watch that balance drop month to month, 9,000, 8,000, 7,000, without seeing it go back up, you will feel a new sensation: Control. Control is better than any purchase you could ever make. But there is one more trap lurking in the fine print, a trap so nasty it borders on predatory. It's called deferred interest, and if you confuse it with a standard 0% APR, it can cost you thousands of dollars in a single day. In the next chapter, we are going to learn the difference between interest-free and deferred interest, and why knowing the distinction is a matter of financial survival.
Chapter 8. Dodge the deferred interest trap. You are navigating the minefield of credit, and so far, you are doing everything right. You've moved your debt, you've stopped spending, you've automated your payments. But there is a landmine buried in the fine print that has destroyed more financial plans than anything else. It is a specific legal term that sounds harmless, but is actually devastating. It is called deferred interest. You often see this on store credit cards, the ones from furniture stores, electronics retailers, or medical financing plans. The headline screams, "No interest if paid in full by January 2025. It sounds exactly like a 0% APR balance transfer, but it is not. The difference between 0% APR and deferred interest is the difference between a safety net and a trap door. Store cards versus bank cards. Let's clarify the battlefield. A true 0% APR balance transfer, like the ones from major banks, Citi, Chase, Discover, works like this. You pay no interest for 18 months. If you still owe $500 at the end of the term, you start paying interest only on that remaining $500. The interest clock starts from that day forward. A deferred interest promotion works differently. Deferred means delayed. The interest isn't waived. It is simply being counted in the background, waiting for you to mess up. The retroactive penalty. Here is the nightmare scenario. Let's say you buy a $2,000 living room set on a no interest for 24 months store card. The interest rate on the card is 29%. For 23 months, you make payments. You do a great job. By the last day of the promotion, you have paid off $1,950. You only owe $50. But then you forget the last payment, or you miscalculate. The deadline passes, and you still owe that $50. In a normal 0% APR scenario, you would start paying interest on the $50. No big deal. In a deferred interest scenario, the bank looks at that $50 balance and says, "You failed." They then go back to day one, 2 years ago, and calculate 29% interest on the entire original $2,000 purchase. They dump 2 years of back interest onto your account instantly. You wake up owing $50 plus $800 in retroactive interest. You thought you were done, but suddenly you owe nearly $1,000. This is legal. It is written in the contract, and it is how these lenders make their billions. That's the key. You cannot treat a deferred interest loan casually. It is a binary outcome. You either win 100% or you lose 100%. There is no middle ground. How to spot the trap. How do you know if your balance transfer offer is deferred interest? Check the source. Major bank credit cards, Citi Simplicity, Chase Slate, etc., are almost always true 0% APR. Store cards, Best Buy, Home Depot, Care Credit are almost always deferred interest. Read the language. Look for the phrase, "no interest if paid in full." That little word "if" is the trigger. True 0% offers usually say 0% intro APR for 18 months. Check your statement. Deferred interest statements will often have a section called Deferred Interest Charge or Accrued Interest.
showing a growing number that you don't have to pay yet. That number is the bomb waiting to go off. The safety buffer. If you are stuck in a deferred interest arrangement, or if you aren't sure, you must operate with extreme paranoia. Do not aim to pay off the debt on the due date. Aim to pay it off 30 to 60 days early. Why? Because technical glitches happen. Payments get returned. Mail gets lost. If you try to make your final payment on the very last day and the website crashes, you lose. You get hit with the penalty. You have a choice. You can trust the system to work perfectly, or you can build a margin of safety. Set your autopay to clear the entire balance 2 months before the promotion expires. Treat the expiration date on your statement as a lie. Your personal deadline is 60 days sooner. The allocation danger. Here is another dirty trick with store cards. Imagine you have a $1,000 deferred interest balance for a TV, and then you go back to the store and buy $50 worth of cables on the same card. When you make a payment, the store might apply your money to the $50 cables, which isn't on a timer, instead of the $1,000 TV, which is. They want the promotional balance to sit there as long as possible. This is why, as we discussed in Chapter 7, you never mix new purchases with promotional balances. It complicates the payment hierarchy and increases the risk of triggering the trap. It's not about income, it's about discipline. Discipline means reading the fine print. Discipline means understanding that no interest is marketing, but deferred interest is a legal threat. You are smarter than their marketing department. You know that free always comes with a cost. In this case, the cost is the risk of a retroactive penalty. You don't need their permission. You don't need to ask the store clerk if it's deferred interest. They probably don't even know. Read the paper. Read the terms. If you see the words retroactive or if paid in full, you know exactly what game you are playing. Surviving the end game. Whether you have a standard 0% APR card or a deferred interest card, the goal is the same: zero balance before the deadline. But life is unpredictable. What happens if you lose your job? What happens if a medical emergency drains your checking account and month 18 arrives and you still owe $4,000? Panic is not a strategy. You need a contingency plan. In the next chapter, we are going to discuss Plan B. We will talk about what to do when the promo period ends and the debt isn't gone. We will discuss the balance transfer daisy chain, the risks of applying again, and how to pivot to a debt avalanche if the banks cut you off. You plan for the best, but you prepare for the worst. That is how you survive.
Chapter 9. Plan B when the promo period ends. We have to be real. Life doesn't always follow a spreadsheet. You made the plan. You calculated the payments. You tried to be disciplined. But maybe you lost your job. Maybe your car engine blew up. Maybe you just slipped up and didn't pay as aggressively as you hoped. Now you are staring at the calendar. The 18-month promotional period expires in 30 days, and you still owe $4,000. If you do nothing, that $4,000 is about to get hit with a 25% interest rate. The monster you locked in the freezer is waking up. Panic is your enemy. Action is your friend. You need a contingency plan. This is not about failure. It is about damage control. In finance, adaptability is survival. If Plan A fails, you don't surrender, you pivot to Plan B. The remaining balance scenario. First, assess the damage. How much is left? If it's a small amount, say $500, and you have any savings, pay it off. Drain the emergency fund if you have to. It makes no sense to hoard cash earning 0.5% interest while paying 25% interest on debt. Kill the debt. But if the balance is significant, $2,000, $5,000 or more, you cannot just write a check. You need a new strategy. Strategy 1. The balance transfer daisy chain. Can you transfer the balance again? Yes, it is possible to move your remaining debt from your current 0% card to another new 0% card. This is called daisy chaining. You apply for a card from a different bank. Remember the bank rivalry rule from Chapter 4. You pay another 3% transfer fee. You get another 12 to 18 months of silence. You have a choice. You can view this as a failure or as a strategic refinance. Buying more time is always better than paying 25% interest. However, there are risks. Diminishing returns. You are paying a fee every time you jump, 3% here, 5% there. Eventually, the fees add up. Credit fatigue. If you open a new card every 18 months, your average age of accounts drops. Your number of hard inquiries rises. Eventually, the banks might stop approving you. They will see a pattern of surfing debt without paying it off. The limit trap. The new card might give you a lower limit than the current balance. If you owe $4,000, but the new card only gives you $2,000, you are stuck with a split problem. Daisy chaining works, but it is not a permanent lifestyle. It is a desperate measure for desperate times. Use it if you must, but know that the ice gets thinner every time you jump. Strategy 2. The hard pivot to debt avalanche. What if you can't transfer again? What if your credit score dropped or you got rejected for the new card? Now you must stand and fight. The 0% shelter is gone. You are out in the storm. You must switch to the debt avalanche method. Rank your debts. List all your debts by interest rate. The expired transfer balance is likely now your highest rate, 20 to 29%. Minimums on everything else. Pay the absolute minimum on your car, your student loans, and any other lower interest debt. Maximum attack. Throw every single spare dollar at the expired credit card. You need to get radical. This isn't about budgeting anymore. This is about liquidation. Can you sell things? Clothes, electronics, furniture? Can you pick up a second job or gig work for 3 months? Can you cut your grocery bill in half? That's the key. You need to compress your timeline. Paying 25% interest is an emergency. You cannot live comfortably while your wealth is burning. You must live uncomfortably for a short period to regain your freedom. The credit score impact. You might be worried about your credit score during this transition. If I open another card, won't my score drop? Yes, briefly. A hard inquiry might drop your score 5 to 10 points. But high utilization, maxing out a card, hurts your score much more, often 50 to 100 points. Moving debt to a new card increases your total available credit, which actually lowers your utilization ratio and can boost your score in the long run. Don't obsess over the 10-point drop from an application. Obsess over the $1,000 savings in interest. It's not about income. It's about discipline. The discipline to prioritize net worth over a temporary credit score fluctuation. The psychological reset. If you reach the end of the promo period and still have debt, you need to have a serious conversation with yourself. Why didn't it work? Did you not pay enough each month? Did you keep spending on other cards? Did a true emergency happen? If it was an emergency, forgive yourself. That's life. If it was a lack of discipline, acknowledge it. Own it. You don't need their permission. You don't need the bank to forgive you. You need to forgive yourself, reset the plan, and go again. Shame is a useless emotion in finance.
Shame keeps you hiding. Logic sets you free. Look at the numbers, make the new plan, execute. The final push. Whether you daisy chain to a new card or hunker down and pay the interest for a few months while you hustle, the goal remains the same. 0. You are closer than you were 18 months ago. You have chipped away at the mountain. Do not let a stumbling block turn into a surrender. In the final chapter, we are going to talk about the victory. We are going to discuss what to do when the balance finally hits 0, not just the transfer balance, but all the bad debt. We will talk about the pivot to assets, the wealth compound, and how to never, ever have to play this game again. You are almost there. Let's finish strong.
Chapter 10. Reclaim your freedom and wealth. You did it. Whether it took you 12 months, 18 months, or a grueling 24 months of daisy chaining and hustling, you are finally staring at the screen. The number is beautiful. Current balance 0. Take a moment. Breathe. Do you feel that? That is the weight of the world lifting off your shoulders. The invisible chain that tied you to your past mistakes, to the bank, and to the stress of making ends meet has been broken. You have defeated the interest monster. You have beaten the bank at its own game. They bet you would fail. They bet you would slip up, miss a payment, and pay them thousands in interest. You proved them wrong. But now you face the most dangerous moment of your financial life. The victory lap and the trap. When people pay off a massive debt, the brain releases a flood of dopamine. You feel rich, you feel invincible, and the whisper starts. You deserve a reward. You worked so hard. Go buy that car. Go on that vacation. You have no payments now. This is how people relapse. If you celebrate paying off debt by going back into debt, you haven't learned anything. You have just run on a hamster wheel for 2 years. You have a choice. You can go back to normal, which in America means being broke and financing a lifestyle you can't afford, or you can pivot to wealthy. The pivot to assets. For the last 18 months, you have been sending $400, $600, or $800 a month to the credit card company. That money was leaving your life. It was a penalty for your past. Now that the debt is gone, you have a massive surplus of cash flow. Do not absorb this money into your lifestyle. Do not start eating out more. Do not upgrade your apartment. You must immediately redirect that $600 a month into assets. This is the rich dad principle. Poor people use their income to buy liabilities, stuff. Wealthy people use their income to buy assets, things that pay them. That's the key. You are already used to living without that $600. You won't miss it. But now, instead of destroying debt, that money can build freedom. Where does it go? Emergency fund. Build it to 3 to 6 months of expenses. This ensures you never have to use a credit card for survival again. Investing. Put that $600 into a Roth IRA or a 401k. $600 a month. Invested at 8% grows to more than $800,000. That is the cost of your debt. That is what you were giving away to the bank. Now it belongs to you. The final truth. The 0% APR hack was never really about the credit card. It wasn't about the math or the transfer fees or the credit score. It was about you. It was about reclaiming your agency. It was about realizing that the financial system is a game with rules.
If you don't know the rules, you are the victim. If you master the rules, you are the player. You learned to audit yourself. You learned to read the fine print. You learned to automate discipline. You learned to delay gratification. These are not debt skills. These are wealth skills. The same discipline that helped you pay off $10,000 is the same discipline that will help you save your first $100,000. It is the same discipline that will help you build a business, buy real estate, and retire with dignity. It's not about income, it's about discipline. You have proven you have the discipline. Now you need the vision. You don't need their permission. You don't need the bank's permission to be rich. You don't need a lottery ticket. You just need to keep doing what you have been doing, controlling your money instead of letting it control you. The final protocol. Here is your final assignment. Keep the accounts open. The paid-off cards are now trophies. Keep them open to anchor your credit age and boost your score. Set a small subscription. Put Netflix or Spotify on the old card and set it to auto-pay the full balance every month. This keeps the card active so the bank doesn't close it, keeping your credit score high. Never carry a balance again. If you use a credit card for points or rewards, pay it in full every Friday. Not every month. Every Friday. Treat it like a debit card. If the cash isn't in the bank, you don't swipe the plastic. You are now free. The road ahead is open. You aren't digging out of a hole anymore. You are climbing a mountain. And the view from the top is going to be spectacular. Congratulations! Now get to work.
Empowering, final, and driving action. You now possess the blueprint. The banks designed the credit card system to keep you in chains, paying 20% interest for the rest of your life. But today, you learned how to reverse the machinery. By executing a 0% APR balance transfer, you are buying yourself 18 months of freedom. You are telling the bank that you are no longer a source of profit, but a master of the system. But remember this warning: the math only works if you do the work. The transfer is just the tool. Your discipline is the fuel. Do not celebrate the transfer. Celebrate the final payment. Go audit your debts. Find the offer. Execute the trade. And once that debt is gone, never look back. Your journey to financial independence doesn't start when you're rich. It starts the moment you decide to stop being poor. Take action today.